Please welcome to the stage Bloomberg's Sonali Basak.
Hello, everyone. Thank you for such a warm welcome. Welcome to the opening night at Bloomberg Invest. 3 months ago, we had Invest in New York, and I've got to say, the world has changed a lot since then. And the welcome to Hong Kong has been remarkable, and the energy has been electric, and dare I say, even bigger than that of New York. So very much looking forward to the program over the next couple of days. This evening, we're going to focus on what I think is one of the hottest areas in finance right now, that is wealth. And we're going to be hearing from a range of leaders about their strategies, driving returns against the backdrop of the current macro environment, as we've said, is very quickly changing. And before we get started, just a few housekeeping points for you. First, we'd like to acknowledge our presenting sponsor for this evening, Standard Chartered, who have helped to make this evening possible. Also, the sessions will be streamed across the Bloomberg terminal, Bloomberg.com and YouTube. It will also be available on demand after. So the whole might of the Bloomberg Media Enterprise will be behind this event. And please do engage with us on social media, because we'll also be active there on #BloombergInvest. A reminder that these sessions are live. Dinner will be served after the conclusion of the program, and there will be drink refills after the first panel concludes. So after our private markets panel, you'll have a chance to refill your wine glasses. And looking forward to a fantastic evening with all of you. And with that, let's get this program started.
Can you grow your wealth anywhere, anytime, without the right partner? Imagine expanding your business to Dubai, marhaba, while setting up a family office in Hong Kong and investing in Singapore. Standard Chartered's unique global network, deep local insights give you unparalleled expertise anywhere right now. Now is your time for wealth.
Please welcome to the stage Sumit Bambri, Global Head Advisory and Managed Investments, Wealth Management at Standard Chartered.
Good evening, everyone. It is truly energizing for me to be here at the Bloomberg Invest conference, surrounded by industry's top thought leaders, our clients, and our partners. So as Sonali said earlier, right, we are operating in fascinating times. The overall geopolitical environment and the global macro is getting more and more interesting, to say the least, and it's creating a whole range of headwinds for capital markets, and the markets continue to move on regardless. Meanwhile, the rate of global wealth creation globally continues to run unabated. Our clients are always questioning, how do I continue to manage my wealth in this difficult macro environment? Our wealth management colleagues are constantly thinking about how we deliver alpha in this difficult environment. So a very, very complex, interesting environment for all of us to operate in. So we see three macro factors or three macro themes that are fundamentally changing the global wealth management landscape. This, we believe, creates a once-in-a-lifetime opportunity. First, the demographic dividends and rising affluent class across our footprint is creating a very, very unique opportunity. We are seeing younger, bolder, more globally aware individuals, entrepreneurs that are doing extremely well and creating wealth and thinking beyond traditional boundaries. This generation is creating wealth faster and deploying it more globally than before any other cohort. A good case in point for this is the wealth creation in India. With over 850,000 high net worth individuals that India will have by 2027, the interesting part is 60% of those individuals will be below the age of 40. This creates a whole new cohort of individuals who are thinking more globally, thinking beyond traditional investment opportunities, and becoming a lot more global and opportunistic in their outlook. China, on the other hand, creates a completely different opportunity. The wealth market in China is huge. But our clients are becoming a lot more sophisticated, and given the interest rate scenario in China, are becoming a lot more open to global opportunities. The addressable Chinese wealth in our footprint has grown to about 1.3 trillion since 2019. And this is driven by very sophisticated risk management and opportunistic views that our clients are now taking. Second, the geopolitical tensions and macroeconomic headwinds are creating whole new supply chain realignments. The traditional east to west supply chain is now getting replaced by south to south, north to south, and a whole new opportunity set is emerging. For example, you're seeing the India-UAE corridor picking up. You see the Southeast Asia to Africa corridor picking up. You see the China to South America corridor picking up. For us, these are not just new trade corridors, these are new highways for wealth creation. Third, financial innovation and technology disruptions are creating a whole new set of opportunities for us. Technology allows us to deliver personalization at scale, and our clients are becoming a lot more confident in using digital tools and engaging with digital capabilities to manage their wealth themselves. On the other hand, with private markets, the opportunities around product innovation are becoming limitless. And that's what we are seeing with a lot of the new products and opportunities that we've created over the last few years, that our clients are now looking at these opportunities to gain access to diversification. They are looking at income generation opportunities and looking at growth opportunities all at the same time. Now, what are the implications for this for us? I think we stand at a very pivotal moment. The wealth landscape that we once knew is changing forever. These are not just short-term tailwinds or headwinds. These are structural changes that are happening in the way the wealth management business is run. Asia, Africa, and Middle East are not just wealth centers or growth markets. These are real opportunities where clients are generating wealth at a very, very fast clip. The new generation of clients I spoke of earlier are a lot more sophisticated and internationally minded and are looking for a whole new set of opportunities that didn't exist before. The policy frameworks, economic models, investment strategies that we create for this new environment have got to be working looking forward rather than the rearview mirror. Institutions that understand this transformation, those who can serve the new generation of clients, that can adopt the new economic cycle, that can connect the wealth creators and the new capital flows that are emerging, and provide access to innovative investment ideas are the ones that will be successful in the future. At Standard Chartered, we are not just observing this change, we are embracing it and we are preparing for it. We've been investing quite heavily in building our digital capabilities so our clients can engage with us in many more ways than possible, delivering more personalized ideas and solutions at scale, embedding a whole new range of product solutions and ideas that our clients can get access to manage their portfolios, and create the right connections for these new trade corridors, these new wealth corridors that are being built. The future belongs to those who will see beyond today's volatility to tomorrow's opportunities. And I hope that you will all gain insights and inputs from the next day and a half. I'm personally quite excited about the sessions at hand, and I hope you will find them useful as well. Thank you so much.
Please welcome to the stage Hui Yango, Head of Alternative Investments Asia at Pictet Wealth Management, Johann Santer, Senior Managing Director and Head of Private Wealth APAC at Blue Owl, and Jason Yao, Senior Managing Director and Head of Greater China at Ardian, for a conversation with Bloomberg's Sonali Basak.
Thank you all again for having us, and it's a great panel to have. Just going back to some of the things Sumit was saying, this idea of limitless opportunities, what a perfect panel to talk about those opportunities with. Maybe we can start, though, with the macro. because, of course, that's not only what everyone is wondering about and navigating at the moment, what it looks like for private markets in particular. When you think about the changes that we're seeing globally, both in terms of the relationships we're seeing across countries, as well as just the state of macro, interest rate differentials, volatility in markets, perhaps we can get started with you, Hui-Yang, about how you're navigating that for your clients.
Thank you. So when we look at the private market environment right now, it is a choppy environment with a lot of volatility, uncertainty, especially on the macro front, policy swings, interest rate, as you talk about. How do we navigate in this sort of environment? So at Pictet, where we have been doing private equity investments for the last 35 years, we have always advocated diversification. Diversification across sectors, across geographies, across different asset classes. Stay true to the long-term objective of generating sustainable, attractive investment returns. And by that, we mean really solid value creation operationally. That's a very key factor for us, number one. And number two, to navigate this sort of a challenging environment, one should look at where the mega trends are. So which are the mega trends with a very strong tailwinds, right? So at Pictet, we talk about thematic investments. So we lean into mega trends, like, for instance, technology and innovation. That's pervasive across all end user markets. So by itself, that's the diversified strategy. We talk about healthcare. Everybody knows, it's aging population. You look at how much is the global health spend. That's estimated to be about 10 trillion, which is easily, a very big percentage of the global GDP. And by the way, out of that 10 trillion, 20% of that is wasted. So clearly there's a lot of inefficiency. It's very dysfunctional, the healthcare system. So when you have situations like that, there's a lot of opportunities that one can look at. I'll just stop here.
So we'll pick up on a lot of that too, but Johann, a lot of people could argue your company, Blue Owl, has been very much in the center of another mega trend, which is that move not just to private equity, but to private credit, to real estate. And Blue Owl has grown tremendously in the last couple of years on the heels of those mega trends. How are those mega trends impacted by the macro volatility of today?
Yeah, thanks a lot, and it's a great question, and thanks for Bloomberg and, of course, Standard Chartered having us here today. It's a great honor. For those of you that don't know Blue Owl that well, we are a 273 billion leading asset manager, but we're also in the forefront of private wealth, which is the subject today. More than 110 billion of our assets under management are actually in the private wealth space. We're also one of the largest credit managers with 140 billion. Direct lending is about 100 billion of the platform. The platform is purpose-built. It's about stability, it's about downside protection, it's about creating a very strong income for clients, which truly works regardless of the market environment. So we feel also that this opportunity is truly an opportunity for private markets in general to showcase and to highlight to wealth clients, family offices, the importance of asset allocation, of having destabilizing assets in your portfolio. So the world is by no means rosy, but when we look through our lens of 400 borrowers on the platform, they are by large growing. They still have single to high single-digit revenue and EBITDA growth. So it's actually quite encouraging. So I believe in the long run, this environment will also show clients the purpose of private markets in their portfolio. It will just help to increase the allocations and the awareness as such.
Implicit in what both of you have said so far is another mega trend, wealth in private markets. Jason, how is wealth management changing the texture of private markets? How is it changing the type of demand and the types of products that are meeting the demand of new investors?
It's definitely a fascinating time. So we see a lot of changes happened in Asia, in private wealth market. So you see the clients here, they are getting more and more mature and sophisticated. If you're talking with them 5 years ago, probably a lot of them, they are chasing after those pre-IPO sort of fast money. But if you talk to those families, high net worth individuals, they were talking about asset allocations. They are more global. and even across different asset class, credit, real estate, secondary buyout, so much more sophisticated. I think according to statistics, around 7 million high net worth individuals from Asia, which is a huge pool of capitals, new type of capitals for private equities. I think in general, if we compare with in US or Europe, let's say this type of investors, they allocate around 15 to 20% to the private equity, compared with Asia is more or less 5 to 10%, which explains why the growth here is 20%. In Hong Kong and Singapore, we see a number more or less. And for example, in Hong Kong alone, you have about 2,700 family office as of now, and they are pretty confident it will be 3,000 family office by the end of the year. That shows how strong this client base is. And on the other side, for the GPs, thanks to the technology development, thanks to the partners with private banks, when they're getting stronger, more local footprint through their platform, we can provide the deal flows, interesting products to those investors. We have been working with many partners, including Standard Chartered banks locally, which has been very successful. I think it's a combination of a lot of the factors which making the Asia private wealth market particularly interesting now.
When you think about the Asia private wealth market, what are you finding most that clients want? Traditionally, that might have been private equity, to your point, or even some of the fast money products, but it seems to be changing in terms of the types of investments that wealthy investors are seeking.
Yeah, so when we look at clients in Asia, for a long time, Asian investors are very familiar and comfortable investing in the stock market, fixed income. So when they want to try something a little bit more complex, like the alternative asset class, they tend to prefer shorter duration solutions, evergreen funds, semi-liquids. I'm sure all of us have heard of that of late. Secondaries is attractive. I'm sure Jason can talk a lot more about that, because there is that hesitation when they hear that, oh, a fund has a term of 10 years. That's a bit a barrier, a mental block, even though private assets is very enticing because it has got the potential for double-digit, very strong returns, but that requires patience. That's suitable for clients with an illiquid pot of wealth.
It's funny, it's hard to have a private markets conversation and not jump right to that hot topic of liquidity these days. Johann, how do you find yourself at Blue Owl changing the types of products you make to meet that demand for liquidity? These are inherently investments that are longer term in nature, yet investors might want the ability to have their money back faster.
Yeah, no, it's a great question. And when Blue Owl started in 2016, we built the private wealth business as a true equal alongside the institutional business. What is truly needed for private wealth to be successful? I always called it 3 ingredients. You need to have the right capabilities. Stable downside protected returns with a high income generation works any given day for private banks, in private wealth, for individual clients. Second one is the accessibility. No matter you have the greatest capability and strategy, if you come in a drawdown format with a 10++, you're eventually not reaching all the clients in the market. So we had our first evergreen strategy since 2017. We have been a pioneer in that segment, and it's eventually a long and a strong component of our business. The third ingredient is having people on the ground. Our clients, our partners, they really need the partnership. They need us to help them bring up the oil penetration in the region significantly. Jason, you mentioned 5 to 10%. From my conversations with some of the leading private banks, we are talking about 3 to 5% on average. In Japan, we are talking about less than 1% of private markets in wealth portfolios. So the opportunity is phenomenal. So we are really talking about the very early stage where there's obviously a lot of room to grow here as well.
I will ask more about how liquid you think this market can really get. But Jason, you and I were kind of joking a little earlier that the word secondary in these markets used to have to come with an explainer after. Now, a lot of people just know what it is because it's gotten so popular. And a lot of that is because of those big institutions needing to sell. Now, how much do wealthy individuals understand the product? How much demand is there now that you are looking at secondary activity, pick up so drastically when it comes to the private market universe?
Yeah, so secondary now is getting more and more popular and well known. So I think if you're talking to the high net worth individuals 5 years ago, they will probably consider you a public manager when you say we're doing secondary. But now I think it's quite well known. So basically we're buying the LP portfolios from the big institutions for the liquidity reasons or regulation reasons. And we also sometimes work with GPs to find a solution for their underlying assets. It's quite an exciting moment for Asia as well, because just looking at the Asia asset, there is a liquidity needs. As the statistic shows, again, before 2018, the DPI of Asia funds averagely is about 0.7. If you compare with the average funds in US, in Europe, their DPI before 2018 is about 1.1. So it's lag behind. There's a lot of reasons, and it's not only one country, it's the whole regions. So I won't expand what the reasons, because it's so many reasons behind it. But which means there's a liquidity needs, and for the sellers who own those assets, they're willing to give a relatively deep discount for those good assets. Now, a lot of times, if you choose these assets will go IPO in the next 6 months, easily you have 2 times return. But they're willing to get a discount, 30, 40% discount, because there's a huge imbalance of buyers and sellers for the Asia assets. So that's for the Asia assets. For the sellers in this region, they are also very active. In the past 7, 8 years, the institutions has building up their private equity portfolios. Now coming to a period of time, they're considered to sort of rebalance in portfolio for various reasons. Sometimes here's the regulation change, denominative factors, geopolitics play a big role nowadays, et cetera, et cetera. So those institutions very actively approaching us and our peers to consider a secondary sale. Given there's also imbalance of demand, the buyers and sellers, so the discount has been interesting as well. And the very good assets, we're talking about global blue chip names, top names, like top 20 names. Yeah, so I think that's also very interesting.
The 30 to 40% number is really interesting to me. For comparisons purposes, Yale is offloading their assets at about a 10% discount. Why is there such a big difference between what you're seeing in the US and Asia?
Yeah, I think, so first of all, the underlying asset is a bit different. So relatively speaking, in Asian portfolio, you still have more growth VC type of investment. Compared with Europe, US, it's mainly buyout. So you have more control, you have good cash flows, which you can predict the cash flows, you can make the models, right? So you need to budget in those uncertainties because of the underlying asset types, its growth, its VCs, a lot of them. So naturally, if you're compare with this portfolio, you have a big discount over there. And there's an even bigger imbalance of buyer and sellers for the Asia assets. So very limited capital chasing after those Asia asset secondaries, which they can have this fortunate, get the luck to pick only the best at a relative quite interesting discount.
Yeah.
Versus in the US, Europe market, you have a lot of secondary players. It's a more mature market, let's put it this way. Yeah.
It's interesting. It gets to another point on the underlying assets. When people think private, they think that the marks don't move around a lot, that there's not volatility based on what else is going on in the world. How do your clients react to that, Yang? Do you find that they are looking for a greater conversation with their managers to see what's going on a regular basis?
So a lot of clients come to us, expressing their interest and desire for secondaries. But investing in secondaries requires a different sort of skill sets because it's about pricing your portfolio. There's always a price for a portfolio, right? If something is going really cheap, big discount, sometimes there's a good reason for it, So familiarity of who the underlying managers are, the GPs, is very, very important. So we have a small secondary business as well at Pictet, but the way we do it is quite different from other bigger platforms. We only buy secondaries bilateral from the existing relationships that we have. Reason being, we are familiar with the GPs. We have underwritten them. We know, are they aggressive or are they more conservative when they value the underlying portfolio company, to your point? Because when they say it's 1.2, should you give 10% discount or should you do a 30% discount? Now, it's not just qualitative, right? It's about peeling the onions, right? And understanding what is inside this portfolio, which are the return drivers in there. And if you are already invested in the GP, you would have been following the underlying portfolio companies, and therefore you can underwrite. It's not about plugging in, your input assumptions into your cash flow modeling and then it spits out a number. You have to be competitive. And the other thing that I would say is that at Pictet, we don't put on leverage. There are different models for doing secondary transactions. For what we do, because we are on a lot of the APACs, the advisory committee, so GPs are quite protective about who they allow into their LP list, all right? So whenever, if as an investor you want to sell, you need to get GP consent. And sometimes the GP would rather keep it within their own network of LPs. And us being in the industry for very long, we have cultivated a very deep relationship. It's an easy call, right? They just place a call. You got to be quick, right? Because it doesn't wait too long, so.
Johann, it's really interesting because what I'm hearing here is that there is a lot of transactional activity happening because of the way people are changing what they want to own, very simply. A little bit earlier, you said that downside protection is something that your investors are seeking. Credit, by definition, is less risky than equity. What do you think is driving this much interest in private credit? And you mentioned some numbers around institutional ownership across different parts of Asia. What's going to drive more interest at this point?
Yeah, I think it's the feel very much that is more similar to what clients already experience in their public market portfolios, eventually in their fixed income funds. Some of the evergreen funds, whether it's a BDC, it's a non-traded REIT, it's more the feel of a very stable NAV slow growth type of an income generating product, which they're already used to. So like if I dial back 10 years ago, I used to work with a leading asset wealth manager in the region. We did about 3 to 4 private market deals a year, 1 credit, maybe 1 real estate, 1 private equity, maybe 1 in secondaries. There's a lot of training going in from the relationship manager population in educating. Again, the format 10 years plus is eventually not too easy. I think the big game changer, in all honesty, were some of these income-generating evergreen products. It started with real estate first. It came with private credit or direct lending next. We see it now in infrastructure. We see it in secondaries coming in. It's the convenience for clients to allocate to these portfolios.
What's the cutting edge of liquidity needs right now? How liquid are these products and where will they be a year from now?
Rightfully, it started with products where there is natural inherent underlying liquidity as well, like in real estate where you have natural income generation, in credit where you have natural income generation, asset-backed financing, you even have a maturity component of the underlying asset in there as well. I'm not going to make comments on the private equity per se. I leave this to the eye of the beholder on that part. I think secondaries, obviously, you are mitigating J-curve effects as well. And of course, it's also written in the terms. You can subscribe monthly, you can redeem quarterly with a certain limitation in place, which ultimately protects all the existing investor in the portfolios as well. But again, I believe the convenience is a massive game changer because you're reaching a wider audience from relationship managers, from clients that are willing to allocate and to build up an allocation. Drawdown funds, still incredibly important. As long as it's differentiated, you have the right strategy meeting the client needs as well.
You know, one of the reasons I was so excited to come to Hong Kong was to see what cross-border investing looked like today. And Jason, you run Greater China for Ardian. What do you think it is that investors in this region, intra-region, really want? Is it to invest more locally? Or are they looking for more opportunities through their fund managers to have exposure abroad, especially given what we're seeing really change underneath the surface in front of us, the changing relationships in the globe?
Yeah, it's a very good question. I think it's very interesting. I think it both ways. You need to be more local, even more local. So it's not like one single largest market you can deploy 80% of your money. Is that easy? Here, you need to understand this is a region of like 13, 15 big economies, and each different countries have its different investment thesis. You have developed countries which are more buyout-driven, carve out from big chapels. You have growing markets, which is exciting with a lot of sort of pre-IPO growth stories, VC, etc. And so different regions, you have different investment themes, and you have a different focus of sectors as well. Say if you're talking about logistics, in some countries, the mainly focusing is the e-commerce growing. So you're putting a lot of e-commerce warehousing, developing project there, versus in some developed countries, it's a lot of IDCs. So even in the logistic, different countries also have very different thesis as well. So that's why you need to be extremely local to monitor those opportunities. So in Asia, it's not like one big economy that give you a narrow spectrum in terms of the risk return profile. Here, it's much wider spectrum, which is more exciting, but you also more risky. So you can have a fund give you 10 times return, but you also can have a fund which is 0.2, 0.3, which is possible, making the managers who is running on the ground even more important. So the clients need to be very selective who to work with, to make sure they have a good local presence, local team, to find the best opportunities, best partners in each country to find the good returns. And I would say cross-regional investment is also important because we see also the supply chains. Now it's not only one country, so it's moving around from China, Southeast Asia, Japan. So there's a lot of cooperation there as well. India, Southeast Asia, I think we mentioned there's a lot of corridors here and there. So it's definitely very, very important. And there's investment opportunities there. You see a lot of cross-border success of consumer brands regionally. The AI cross-border collaboration, et cetera, et cetera. I can give a lot of examples of that. So that's also very important. I think so, yeah, both ways.
It's interesting. Over the 2 days, of course, this is my favorite moment of the week, if not the year. My second favorite moment of the week is actually Thursday's U.S. 30-year Treasury bond auction. And of course, it's because people are looking so closely at U.S. assets and the demand for them. Johann, when you talk to clients across Asia, do you find that interest is waning? Are they looking more towards Europe instead, or even more locally? How do you navigate that tension?
No, it's a great question. It's like there is an element of that wholeheartedly. We see that. But one thing I've learned in 19 years being here in this region and affiliated to Wealth, there's first and foremost always a home bias. That's true probably for every market. But other than the home bias, US is a real large overweight in every client's portfolio. And while we see conversation for clients obviously shifting to Europe, and there are definitely great opportunities, Japan, India, other markets, it's literally impossible whether you are focusing on public markets or private markets to ignore the US. So, and one thing I also learned, never bet against the US and never bet against the US dollar in these 19 years here as well. So there is momentarily arguably shift, and from an asset allocation perspective, I think it makes all sense. But when it comes to scalable solutions, when it comes to finding opportunities, again, like truly scalable, which have an inherent element of protection implemented as well, it's hard to ignore the US in all honesty.
I'm going to ask you both this question too, but I'll make Hui-Young really focus on it first. I think this is one of the harder questions because you have India, you have Japan, there's so many areas with so much promise. Which is the favorite among your clients?
In Asia or just globally?
In Asia.
Well, it really depends on where the client is. If you just look at China, right, valuation has come off. Is this actually a good opportunity? But for non-Chinese clients, they may think twice because of exit. It's not quite proven. Challenges in navigating that. When you look at India, I think there's a lot of buzz, there's a lot of startup, a lot of innovation, there's a lot of entrepreneurship. But the exits, well, there has been some exits, but I guess it's not quite very well proven as yet. So to be seen, valuation is also quite intimidating. And when you look at Southeast Asia, I think it's really depending on your cup of tea, right? Southeast Asia, some people say that it's not shallow. Some people think that this is a great opportunity because, on the one hand, people talk about deglobalization. What's the opportunity when you have deglobalization? You talk about regionalization, right? So ASEAN is actually a big opportunity as well. But I just want to extend beyond that. So Johann talked about US, undeniably US. I think it's a very big economy not to be invested in. A lot of clients are overweight there. So clients, some of the clients, we're seeing that they're thinking about maybe dialing down because they're so overweight in there, right? So where can you dial it down? Well, if you're comfortable in Asia, there's a lot of opportunities, but it's very fragmented. Again, one needs to be careful because the rule of law is not the same everywhere in Asia. And then you have to deal with foreign currency, right? Do you want to hedge? How do you hedge? But I just wanted to spend a minute about Europe. So Pictet is a European bank, right? So when you look at Europe, interestingly, real estate is getting very attractive, all right? You can now look at real estate properties, opportunities at 30-40% discount, the replacement value compared to a few years ago.
The golden number of the day.
Yeah, and the other thing, it's the divergence, right? We talk about interest rate. Just look at US and Europe, the central bank's policy when it comes to interest rate. ECB has gone the furthest and the quickest, right? With the last cut just 2 days ago is at 2%. US is still hovering at 4.5. I think they want to take a bit more time to figure out whether or not there's going to be inflation impact. So when interest rate goes down, what it means is that you can expect an uplift in your real estate valuation. And the second thing that a lot of people don't quite appreciate is the long-term structural oversupply in Europe, okay? There's too much, undersupply, all right? Because they have very archaic zoning rights permits. As such, it's very difficult to get a permit to build new constructs, new properties. And so there is an undersupply. As such, you wouldn't believe this, right? Just look at London. Do we think London is growing very well despite its attractiveness as a financial hub? Right? Last year, it only grew by 1%, but the rental growth for residential was up 11.5%. That's phenomenal. Now, just in contrast, just to finish it off, in contrast, let's take another city in US, say Austin. For those of you who have been to Austin, Texas, it's a booming city in a booming state, all right? The unemployment rate is at the lowest, even below the national average. The residential rental has actually plummeted 23%. Why? Because it's overbuilt. So US overbuilds and Europe underbuilds. So explore this opportunity. It's quite an interesting one.
I will confirm we have been spending an enormous amount of time in real estate as well. Jason, just to kind of comment more on where people are going. You talked about the regional opportunities, the diversity of the opportunities. Where is drawing the most interest and why?
You mean the regions? Or
and within the regions.
Within Asia?
Within Asia.
Okay. I was about to say Europe otherwise.
I'm going to make you choose your favorite location.
Yeah, so again, I mean, Asia, different countries, they have, present very different opportunities. And different countries, it's all have its exciting opportunities there. So, I mean, if you're looking at to deploy your asset, there's a few very big economies that's where you should probably consider to start with. Of course, China, India, Japan, Korea, Australia. ASEAN is definitely big. But I mean, just compare in the private equity history, if you just go through the lines, probably, the countries I have mentioned, with proven managers, proven exits. So again, I think because it's not one single countries, I will be very careful if you putting too much of your allocation into one region, one countries, given there's so much volatility here. So something pan-regionals, pan-Asian, who have the managers, can balance. They have all the teams in different place, but each year they have a different themes, different regions as their priorities. I think it will be better to work with instead of, have double down in one of the countries. If you have high risk, high return profile, some of the countries may be very interesting, very low valuation to start with, or very interesting technologies you want to betting on. But I think as asset managers, I will still be cautious, still aiming for long-term or more steady sort of returns.
Johann, I'll leave you with the final word here because I didn't get to tell you this. I've covered Blue Owl since before it was a $1 billion company. And so Europe has actually been one of the places that it's been growing a lot. And so to the point that Huiyang and Jason have been making, why, right? I mean, why is it drawing so much interest, especially from investors in Asia? It's easy to see why this year, but why in the long-term sense?
Why in the long-term sense in Europe? I think, again, I think it comes down to scalability of the market. Clients are arguably quite allocated to the US by now, and you find other large pockets of assets that are scalable, that have downside protection inherently implemented in the business. In Europe as well, you have a healthy direct lending industry, you have a healthy real estate market, you eventually have a healthy secondaries market in Europe. It really shows the signs of scalability where we are investing as a company, arguably and heavily as well.
It's great to speak to all three of you. It's a perfect way to set up the rest of the conference as well. These are all things that will be discussed more in greater detail tomorrow. Thank you again, and we will be serving more refreshments as we hold on for our next panel.
Thank you.
Gurmeet Chadha, Managing Partner and Chief Investment Officer at Complete Circle Wealth, and Sunil Chandrawat, Head of Research and Senior Investment Analyst at Shikara Investment Management, for a conversation with Bloomberg's Jeanette Rodriguez.
Ladies and gentlemen, good evening. Thank you for your time today. We have a single point mandate this evening to prove to my colleague Sonali that Asia is far more exciting than the US 30-year Treasury auction. So let's jump straight in with the conversation. India, of course, exciting, however you interpret that word. Let's look at the gamut of what India can offer, and with our two panelists this evening. Sunil, let's start with you. Your firm, of course, Shikara, largely based in Hong Kong and New York, looking from the outside into India, managing a lot of money. How do you see India?
Right, thanks, Janet. So, just from a broader sense, right, there are three reasons why we like India, and I think it's very uniquely positioned, within the global markets. Number one, there is a strong internal market, so there's domestic demand. There is a demographic dividend. I think the previous panelist did mention about the young population. And then the third is a structural shift in policy from the government, which is infrastructure push, manufacturing in India, make in India. So these are the 3 or 4 factors. And if I want to leave one number, India's GDP is close to about $4 trillion, 3.54. Nominal growth is right now 8 to 10%. So you expect India GDP to double by 2032, 2033. That's 4 trillion incremental economic size. 60% of that is consumption. So there is a $2.6 trillion of consumption demand in the next few years coming from India.
Gurmeet, coming to you. Yes, India is certainly growing. It's certainly a very exciting market in terms of the potential. But one argument that can be fairly made about India is that it's difficult to price risk in India. As we made the argument earlier as well, it's an unproven market. The opportunities are plenty, but the realities of doing business on the ground are complicated. You have boots on the ground. Your firm operates there. Complete Circle makes wealth there. What should a foreign investor know about India before really stepping in?
No, that's a good one. So I think the data is good, but the real picture is even more beautiful. If you see Nifty 50, which is our index, 10 years back, the profit pool was $25 billion. This year, ending FY25, it's $100 billion. So the benchmark return in INR is 14%. So you don't need any of us to make 14% in India. That's been the return for the last 30, 40 years. In dollar terms, that's coming to around 11%. So gradually post-COVID, institutional capital is now getting more and more comfortable. It's largely led by the earnings growth, which is almost in line with this number, which is 14, 15%. Just see the exit. India market was never that deep. FPIs in last 2.5 years have exited a little over $30 billion. In fact, we see big quantum exits of billions of dollars happening in a single trading session. KKR is exiting, Ask Wealth Management firm. We saw a bank getting exited and bought by the Japanese firm. So billion-dollar deals are happening now, over the counter. So that liquidity, the exit part, I think is something which has materially changed post-COVID. We have had 20 crore new demat custody accounts opened in COVID. So 50 million clients came from independence till COVID. 4x of that came post-COVID. So I think this is a resurgence happening, especially in tier 2, tier 3 towns. So some of the change is underway. You can see that in defense, in electronics, a bit of that in semiconductors. Some of the change is where you now need to focus on, which you can be early.
Gurmeet, I want to come back to you with that tier 2, tier 3 city idea. But first, I want to go to Sunil, because Gurmeet spoke about these sectors. And certainly, we are seeing India as a stock picker's market. You certainly have to see the growth and make a conviction trade in a lot of places. And those who have done so have really made a lot of money. Where are you telling your clients to invest in India? Where are your conviction picks within India? And why, of course?
Right. So, I was discussing about theme. Let me elaborate that. About, India's population, average per capita is about $2,500. 2023, there were about 40 million people in India earning more than $10,000. By 2030, this will become 100 million. So more than doubling. And I don't need to tell you that. Above $10,000, your discretionary spending wallet share goes up materially, whether it is autos, whether it is capital goods, whether it is traveling. That's one theme. The other one is hospitalizations or hospital sector. As again, your income level goes up, you want preventive medicine, preventive diagnostics, as well as a higher quality healthcare space. We are seeing all new businesses coming in this space. The other one is, I said about financial inclusion and digitization. So, in the last about 10, 12 years, 99% of India's population has its own 12-digit biometric ID. That helps in financial inclusion. So, again, in the last few years, 500 million new bank accounts were opened, which means these people were never banked and now they are in the banking system. And the last part, I was referring to the infrastructure push. So India has committed to about $1.3 trillion capex, which has started a few years back, will finish in 2027. There's a big thrust. This is in energy, defense, road, railway. This definitely creates jobs and creates and removes long-term bottleneck within the space. For another example is railway in India is spending about $137 billion capex in the next 5 years. And what this means is the capacity will increase by 200%, almost doubling of the capacity. This definitely benefits manufacturing because logistics is a key bottleneck. So these are the few areas that we are looking at it. Within space, we tend to look at either sector disruptors or industry leaders. That's where I think you have an edge. This is how we look at it. Yeah.
Gurmeet, same question to you. What are you really telling your clients? Where are the spots within India to make money?
See, one good thing about a market is that if you get one macro theme right, there is plenty of wealth to be made. So in 90s, if you got IT right, internet right, it did not matter whether you bought Infosys or TCS or HCL. Everybody became 100 baggers. And every country goes through a cycle. So I think we are now going through this manufacturing reemergence. Right. Now, if you look at, for example, Korea, from 80 to 86, their share of manufacturing went up from 20 to 27%. It happened to Indonesia from 86 to 96. It happened to Vietnam from 2010 to 22. India's manufacturing to GDP was 11% in 2013. We are at about 15%. And there is an official goal of 25% manufacturing to GDP ratio by 2030, which means the current market cap of manufacturing is $500 billion. So the economy will grow from 4 to 10 trillion in next 10 years. The manufacturing will grow from 500 billion to 2.5 trillion. So there's a 5x opportunity in manufacturing. And then you can break it down into defense, auto, electronics. To give you an example, electronics, 15% of the iPhone now are made in India. It will be 25% in next 2 years. Dixon is now almost making 60% of the display panels of the world. So we are moving up the value chain on electronics. The second big opportunity, which Salil also mentioned, is the financialization of savings. So we have more investors joining from tier 2, tier 3 towns. In fact, 50% of the new investors are coming from tier 2, tier 3 town. Look at this way, FIs have sold 1/3 of their holdings. They owned 23% Indian stock market. They're down to 16% in last 9 years. The market is just 4% away from its all-time high. No, I have not seen that in my 22 years where FIs are, if somebody would have told me 3 years back that FIs will sell $30 billion, I would have probably taken put options and, been on cash. So I think that's the second big change. And the third one, most importantly, is this rising entrepreneurship. India's startup ecosystem is thriving. We say Bangalore is the hub, is the Silicon Valley. You'll be surprised, the startup hub for last year was Lucknow. Each state is now developing, startup. And the driver for US or China or any large market is the innovation ecosystem. And I think to me that is a subtle change, which is still not getting captured in the market.
Gurmeet, for businesses across, I'm hearing this theme across that the growth is coming from the tier 2, 3 cities. And unlike many other countries in the world, in India, most tier 2, 3 cities speak completely different languages, quite literally completely different languages. Yeah. It's unlike the US, it's unlike China, it's unlike most other places. It's more fragmented. It's multiple countries within one country. Yeah. How can you tap that kind of growth when you literally don't even speak the language they do?
See, one good thing about, and I think that's the case with Hong Kong and China too. I had a lot of difficulty in telling my cab driver in the morning where to come from the station. But one thing with India is the English-speaking population. I'll give you a figure. 20% of the global chip designers, engineers, work in India for MNCs. Most of the GCC work now is getting outsourced to India. So one is, we are very focused on the FTAs which India will sign with UK, US. There is a second order impact. So for example, with UAE, we have a great equation. We have a GCC pact. So all the work which UAE will get because of the UAE-US deal will get outsourced to India because of the equation. Same thing with Japan. So while the headline would be FTA with US, UK, the second order beneficiary, so we are the back office, we are now the GCC, and now we are gradually become the manufacturing. I think the one challenge and one opportunity is rise in this English-speaking population. And I think that's where these tier 2 towns with Indore, Lucknow, the different state capitals. One thing the government has also done, Janet, is there are individual GDP targets. So I tell my clients, don't look at India as a part of EM. Look at India as core allocation. And then different Indias, within India. For example, Maharashtra, which is the largest state, has a 1 trillion GDP number by 2030. Uttar Pradesh has a 1 trillion GDP number. I am talking of Indian states now, talking of $1 trillion GDP, which is more than some of the EU members. So that challenge, I think, with skill upliftment and all will take it. See, some challenges would be there, but I think it's work in progress.
Work in progress, certainly. Yeah. All of the previous panelists were very excited about Europe, because Europe is like India, right? It's a large continent which speaks different languages. But very, very rightly, there was mention of rule of law, there was mention of contract enforcement. India very notoriously lacks in some of these areas. And we're very upfront with that. There are certain areas that foreign investors have to adjust for, have to factor in when they come into India. So Sanil, what are these factors that you adjust in when you bring your foreign money into India?
So from a regulation standpoint, I think we have all the requisite licenses. So generally, it's a dollar fund outside. But I think if you are referring to from a business standpoint as well, I think one big risk as an investing side we see is, can India really grow at 8% real GDP growth, right? Versus today about 8 to 10% nominal, deflator, you are at 6.5%. India spends about 7% of its GDP as broader capex. To grow higher, you really need to spend on infrastructure and capex. As an example, for 20 years, China spent 10% of its GDP on capex for 20 years. So I think that's a key challenge. We need serious structural reforms, land reform, labor reform. Last part is creating jobs. So, based on broader statistics of younger population coming into workforce as well as agricultural shift, India needs about 8 to 10 million jobs per annum. And I think this both is a challenge as well as a benefit. As manufacturing picks up, you see all these jobs getting absorbed.
What I can see the timer going red on the clock. So, what is the key kind of questions that your clients ask you, Sanil, about India?
From a medium-term perspective, so very broadly, if you're looking from outside, it's always been a hope story. Why now? Right? That's, I think, a very key question for us. Why now? So our view is, one, it's at a cusp of consumption. From 3.54 trillion moving to 8 trillion in the next 10 years. This journey is very different. You need to do basic necessities, basic infrastructure investment, all the basic things. We believe now that is moving up. 100 million people, more than $10,000 is a very powerful cohort for any corporate to invest in and target. The second is, as I mentioned, about infrastructure and PLI scheme. So a broader geopolitics diversification strategy. The government has come out with this production-linked incentive scheme. We are seeing early benefits in electronic manufacturing. We are seeing benefits in textile manufacturing. We are seeing benefits in pharmaceutical manufacturing. So, where next? Would this be successful? There has been some failures here in some few sectors. So, that's been a challenging part. So we try and navigate through as to, where there's a new policy now for semiconductor as well. The government and the private entity is combined spending about $19-20 billion. One question is, will this really happen? These are the few factors that we are closely monitoring.
Gurmeet, a lot of the factors Sanil mentioned also rely on the geopolitics. Certainly very interesting times in terms of the geopolitical story. Diversification is the big theme. India has historically been seen as this aeroplane sitting on the runway. Especially foreign investors, we hear of a cycle, right? Every 10, 15 years, India is the next aeroplane to take off. But the ATC just tells us, hey, hold on, let some other aeroplane go by. Why now? The question to you is why now? Why is this time different?
Yeah. So two things. One, I think we are non-aligned. We are not part of any, we get along well with both Russia and Ukraine, for example. We get along well with China too. So this one, we are non-aligned. Second, we have never been the aggressor. We have no territorial. So what we are seeing now is that, so there were two events which I say have been path defining. One is the fall of Berlin Wall in 1989, where globalization started. Second is 5th November 2024 when Mr. Trump got elected. So I think the reverse of that will now see. You'll see a lot of regional deals, FTAs. So it's a reverse of what has happened in globalization. And there are few areas India stands out. One is defense, for example. So we have light tested. We don't need simulators to test our defense capabilities. India, for example, our air defense system used AI, which based on our satellite systems, to dispel any drone attack. So this is the most advanced form of defense system anybody would have seen live tested a few weeks back. Some of our hypersonic missiles are Mach 5, which is 5 times the speed of sound. Now, I would not have imagined India making Mach 5 hypersonic missiles about 10 years back. We were net importer of defense. We are already talking of defense exports worth few $1 billion. This year we've done $4 billion of defense exports. So that I think that runway is on the takeoff. EU has been asked by NATO chief to do 5% of GDP spend on defense. Now that number is $1 trillion, right? India would increase defense expenditure. I think we'll be a big beneficiary there. The second beneficiary, India, where I see the plane on the runway, is this lower segment. We have 500 million people in India who have never been to a mall. As per a World Bank report, about 170 million people got lifted out of poverty. These guys need gadgets. This is an aspirational India. They want to own a two-wheeler. They want to own a smartphone. They want to ride a good car. They want to own a house. And that is the reason whenever anything geopolitical happens, we are cushioned off because we have a huge domestic demand to be met. I think that story is also on the runway. As per capita picks up, should take off. The third one, where we have already taken off, as Salil has said, I think is defense, pharma. Whenever anybody gets time, just read the Biosecure Act, which US wants to, pass in the House. The Biosecure Act talks about US being very fearful of, gene mapping, gene theft on some Chinese companies, right? So, and there are drugs worth billions of dollars which are going off patent. The new war in future could be biowarfare. And that is where India fits in. We are very trusted. We would not stab anyone. We would not be the aggressor. And I think with this geopolitical equations changing, India would more often be seen as a trusted partner. Second, we are very frugal in our engineering. We'll always offer, we can send a mission to Mars at 1/10 the cost, which NASA does. So frugal engineering, human capital, and being trustworthy, I think are the opportunities.
Well, Janet, just to add on two parts of why now, with this whole shift in manufacturing as +1 strategy, India came out with a policy of lowest tax rate. So for a new manufacturing facility, 17.5% tax rate for 10 years. It's lowest within the Asia region. That's kind of an incentive to corporate to come in line with what Singapore tax rate is. The second is the labor cost. So India's labor cost today is what was China's labor cost in 2000. That's 25 years back. So these are the two factors that drives corporates invest, build manufacturing capability, and that's where I think why now.
Well, to your point about space, we hopefully, fingers crossed, India will send an astronaut to space after 40 years. That's tomorrow. The launch is scheduled tomorrow. But Sanal, to your point about manufacturing, let's spend some time on services. The final couple of minutes on services as well. Historically, India has always been, while China has focused on manufacturing, India has focused on services. So, Gurmeet spoke about the GCCs. All of the large Wall Street banks, their largest offices outside of New York, of course, are in India, including, so Sumit will probably put more money into India as well, hopefully, very soon. Where do you see the services story, and where are pockets of opportunities in services?
Okay, so you mentioned about GCC. Let me just add that. So GCC is Global Capability Center. There were 1,000 centers in 2019. Today it's 1,700. So within a span of 4 or 5 years, 70% increase. They employ about 2 million people. To me, the language, relevance, which is English, education system, younger population, these are the 2-3 factors that has led to this growth, and we still see this growth. Our interaction with a couple of these, the residential REIT providers, the commercial, they are seeing very good demand from all these global GCCs to coming into India. And I think broadly the alignment on a geopolitics side kind of also aids to that.
Absolutely, office space is at a premium,
yes.
premium in India. Ask me as somebody looking to get a new office space. Yeah. Final thoughts about India. When is the right time to enter?
I think the best time was about 20 years back. The second best time is now. And also, I think, look at our index. We follow US with a 10-15 year lag. So look at the top companies in US today. They're all digital companies. Tesla is an auto company, it's a digital company. Amazon, Microsoft, Netflix. Netflix has a market cap more than Reliance, which is our largest holding. I think we are yet to see our own Amazon. We are yet to see our own Netflix. We are yet to see our own Tesla. And I think as we grow along, a lot of companies will enter. Our largest company is just $300 billion market cap. Right? So I think digital space, in my view, you will see more opportunities. I think one of our defense companies would be in top 10, 20. That's my view. So you have to take a bit of a leap of faith here and see what are the emerging trends there. And right now, our financial sector is 35% of the market. I mean, that's not going to sustain. Other sectors, services, as you rightly said, other sectors will make way. And if you get this trend right, manufacturing, defense, financialization of savings, I think there's plenty of wealth to be made.
And Santer, are you convincing your investors to take the leap of faith in India?
Indeed. So, last 10 years have been exciting, but we are actually even more excited now than before. So, indeed, we are positive. We are seeing a very good response from, our interactions with our potential investors as well.
Well, that's India for you, ladies and gentlemen. Thank you very much again for your time.
Please welcome back to the stage Bloomberg's Sonali Basak.
Well, so much for joining us tonight. I'm very much looking forward to the dinner and, of course, the rest of the conversations tomorrow. Jeanette, I'm going to be borrowing from you to see what other airplanes are taking off. We have a truly global event for you tomorrow with investors across many asset classes. I'm looking forward to seeing you there. Enjoy your dinner, and looking forward to hearing what you think and what you are hearing across our programming all of tomorrow. Thank you.